and welcome back to our next Wealth Building Strategies Masterclass series. Today I'm going to be spending some time with you going over both passive and active real estate investing success. If you want to reach out or connect with us or become part of our professional investor network, you can text PASSIVE to 66866, or you can visit our website at investwithdmi.com. DMI Holdings is based in Dallas, Texas. My name's Eric Mattingly. I'm the owner and founder of DMI. My partner is Leon Shasteen. He's the other owner. And DMI provides passive investment opportunities for individual investors. We focus on forming strategic partnerships with quality operators we can invest with. And DMI has completed a little over $1.5 billion in investment transactions from 2008 to present, totaling a little over 100 private placement offerings. So let's talk about how to have success investing in real estate. So here's our agenda. I'm going to cover the difference between active investing and passive investing, transactional investing and cash flow investing, taxation, both passive income and active income, and how to conduct due diligence and what due diligence is, owners and management, and then we will do a little test at the end with some Q&A to see if you can remember some of the main points through the presentation. So what's the difference between active investing and passive investing? So anytime an investment transaction is put together, you have an active investor and you have passive investors. The active investor need passive investors to fund their investments, and the passive investors need active investors that are going to go do all the work. But there's some things to consider on both sides. So an active investor needs training, education, knowledge, experience, and successful mentors. The active investor is the operating partner. They're the ones that's going to do all of the work on the investment. So they're going to identify the opportunity, conduct all the due diligence, organize investment opportunity, marketing piece for the lenders to look at, as well as the passive investors to review. Also going to line up all the debt and the equity. The equity is the investment opportunity for the investors. They're going to manage and oversee the project, and they should have a clearly defined exit strategy. They're going to handle all the closing and the exit strategy. And some of the roles and responsibilities of the active investor is that they need to understand each investor's investment objectives. They should be honest, ethical, have integrity, and do exactly as they say that they will do. The active investors should limit the investment amounts that are suitable in relation to the investor's net worth and investment objectives. So if an investor has $1 million net worth and they want to invest in your multifamily deal or whatever investment you have, and they want to invest $500,000, that's not suitable. That's 50% of their net worth. Normally, we recommend and will limit investors to no more than 10% of their net worth at a maximum in any individual investment opportunity. And the active investor's job is to report regularly to the investors. If you have investors calling you and asking what's going on with the investment, you really have no business working with the investor's money. So it's your job to make sure that you provide reporting to your investors, whether you're working with investors on a small scale. If you're somebody who fixes and flips homes and you have investors, my recommendation is that you set up you might have an LLC and you set up a separate bank account for each separate property you're doing, even if you're doing it under the same LLC. And one way you can easily report is give your investor or investors view access to the bank accounts for that particular property. And so you could have 10 different properties, 10 different investors, and you give each individual investor view access. That's a great way for them to feel comfortable that you're using their money for what you intended to do. If If you're doing larger transactions like a multifamily project or a commercial project, there's going to be a professional property manager. They're going to produce a comprehensive report, and you need to just share that with your investors so that they can see what's going on with the property, both financially and operationally. Some additional roles and responsibilities is that the active investor needs to have a qualified bookkeeper or CPA firm to handle the accounting and investor distributions, and has a total transparency policy and provides full disclosure financial for investors. Again, if you're working with a property management company and they're going to produce a very comprehensive report, all you need to do is just share that with your investors and they'll see exactly what's going on. And then at the end of the year, CPA firm needs to produce the K-1s or 1099s, depending upon how the investment was structured, to the partners in a timely manner. On a private placement, the goal is to get all the K-1s or 1099s out to investors by March 15th. Sometimes that's not possible. You are relying on the CPA firm, but you want to get them out as quickly as possible so investors can file their taxes on time. The passive investor's profile is they should obtain knowledge. One of the ways investors can obtain knowledge is by listening to and learning from workshops like these. You should understand the kinds of investments, how they're organized, and understand what the objective is for the investment and make sure that it's in line with your own personal investing strategy and objectives. You need to gain experience. You can do that by, investing. You can do that by studying and learning from different types of forums like this. And if necessary, use third-party, non-biased advice. So one of the things that we run into quite a bit is an investor is considering investing. They've looked at and reviewed all of the information, and then before they decide to invest, they say, let me run it by my financial advisor. In most cases, you've got to be careful because sometimes asking for advice may be nothing more than a worthless opinion. So if a financial advisor, for example, is with, say, Charles Schwab, first and foremost, there is a huge conflict of interest because that advisor receives payment for the amount of money under management. So any investments that you pull away from them and you put somewhere else means that they make less money to feed their family with. So right away, there's a conflict of interest. Secondarily, if you are going to use, and some advisors are great, and even though they may be with a organization, they may have some knowledge and they want to, and you have your best interest at heart. But there are restrictions. If you're working for Charles Schwab, you're not allowed to legally recommend other investments to people outside of what is being sold through Charles Schwab. There are third-party investment advisors that can truly give you a non-biased opinion and that get paid for financial advice. And there's nothing for them to lose or gain. They're going to get paid whether you do the investment or not. That's true third-party advice. And you want to make sure that whoever is providing you the advice, I'm just going to use multifamily as an example. It's real estate, it's multifamily, and it would be organized through a private placement offering. So whoever is advising you needs to have either invested personally and has experience doing so, or regularly provides advice on real estate transactions and private placements for the purpose of being able to actually give you, a third-party opinion for you to assist you in making a decision. The passive investor is the financial partner. Your job is to review the investment opportunity, understand the due diligence done on the project, validate due diligence if possible, and write checks. The passive investor's roles and responsibilities are review the reports and financials. The active investor goes through a lot of work to make sure that the investors are informed, and you also want to be knowledgeable. So take the time. Nobody cares about your money more than you do. And although you're passive, it doesn't mean that you shouldn't be educated. And then be a reliable financial partner. So as an active investor, you rely on your financial partners. You work really hard to do a good job and build confidence, and you want those investors to be there for you as you can continue to do other projects. So you want reliable investors. So don't tell your active investor partner that you're going to do an investment and then you don't do it. That could create some problems for them. A lot of times these investments have strict timelines and guidelines, and you have to have a certain amount of capital organized within that period of time. So it truly is a partnership between the active and the passive investor. And then only invest in investments that meet your personal investment objectives. If you are a cash flow investor and you must have cash flow on every single investment, and you are presented a land deal, don't invest in it. It doesn't meet your objectives. There'll be other opportunities to look at. And then only invest a suitable amount of your net worth in any single investment. And so whether the sponsor on the investment will allow you to invest an unusually large amount, as a rule of thumb, we recommend investors don't invest more than, at a maximum, 10% of their net worth in any single investment. So let's talk about the difference between transactional investing and cash flow investing. In single-family investing, there's over 21 strategies that you can use to invest in single-family homes. And so some of them are transactional and the others are cash flow strategies. So let's look at some of these options. Transactional investing can be done both active and passive. So if I'm the guy that's fixing and flipping a home and you're the investor, my investor that's going to fund that fix and flip, I'm the active investor, you're the passive investor, even though it's a fix and flip. So you can have both somebody on the active and passive side. Transactional investing is short term. It's not designed to be long term. That's why it's called short term strategy. And depending upon the kind of investment you're doing, I would say short term is anything that's 18 months or less. A typical fix and flip, for example, generally should take less than a year, 1 year maximum. Ideally, it's closer to that 6 month to 8 month time frame, but it's short term. You're basically buying and selling. Buy, fix, and sell, otherwise known as a fix and flip. That is a transactional investing strategy, an assignment of contract. So if I tie up a property for $200,000 and I find somebody else that wants to buy that property for $210,000, I can assign the contract over to them and receive an assignment fee of $10,000. That's a transactional strategy. Hard money lending, it's transactional. You're doing loans that are designed to be out there for 6 months, 12 months, 18 months tops. It's not to say there are hard money loans that don't go beyond that period of time, but generally hard money lending is done because the money is not going to be tied up long term and they charge very high interest rates. So as an active investor, you don't want to have a long-term hard money loan because it can put a lot of stress or even completely eliminate the returns on a deal because of the cost of interest. Cash flow investing can also be done both actively and passively, and the income is passive. You're not doing any work for it if you are the passive investor, but it can produce passive income. There are a lot of things that produce passive income. Single-family rental properties produce passive income, provided you're not if you're actively managing the property, then you're actively investing in a cash flow property. If you are using a property management company, then you are passively investing. You can do mortgage assignment arbitrage, seller finance. There's commercial cash flow properties like strip centers, condo projects, multifamily, and so on. Lending. Lending is a great cash flow strategy where you can be in a first lien position, receive interest payments on a monthly basis, and is a great way to safely generate a good return on your investment. And you can invest in businesses that kick off cash flow. Taxation, both passive and active. So passive income is taxed at a flat rate regardless of your income tax bracket, and it depends on your personal tax situation. There's depreciation deductions that you get, loan proceeds. So if you refinanced a property and you got a loan proceed distribution, that is tax-free at the time it's received. A 1031 exchange is sometimes used when somebody is selling a property. They have a large capital gain, and then they can exchange it into a property of equal or greater value and defer their tax indefinitely. We work with a lot of 1031 exchange investors. Generally, when we do a multifamily project, I'd say 70% of the time, at least one or more investors is a 1031 exchange investor that's coming out of a property as a gain, and they want to reallocate their funds. The active income is based on your earnings and your personal income tax bracket. Tax laws are written against active income, so you want to try to get as little active income as possible and have as much passive income as possible. Any income taxed as active affects your tax rate. This is there's one of our wealth building strategies workshops, investing pitfalls, mistakes, and problems. I talk a little bit about this, but just to touch on this, you really want to think about what kind of investments you're doing and where they're doing them and how they're taxed. So just to give you an example, if somebody is in a 28% tax bracket, and they are going to trade stocks, and let's say all you needed is an additional $10,000 of active income to bump you into the next tax bracket, 33% or whatever it is. Well, if you're buying and selling stocks, and let's say you generated an extra $12,000 a month in earnings from short-term capital gains, well, it's great that you made that return, but you just bumped yourself up to a higher tax bracket that affects all of your income that you get, which would negate the profits that you just made by buying and selling stocks. It would be better to do those short-term strategies inside of your IRA, which wouldn't affect your earned income tax bracket because it's inside of a tax-deferred structure. So when you're investing and where you're investing, it's very important to understand what your personal tax situation is and making sure that you don't wind up bumping yourself up into another tax bracket. The next part of being successful in investing, regardless of what it is understanding due diligence and conducting due diligence. So what is due diligence in real estate? It's taking caution, performing calculations, reviewing documentation, procuring insurance, walking the property, essentially doing your homework for the property before you actually make the purchase. What is the due diligence period? The period immediately after the acceptance of a purchase and sale contract to buy a property is the due diligence period. This time period is very crucial in determining if the property is a right fit for you as the buyer. And for the seller, this time period means inspections and possible further purchase negotiations are going to occur based on what's discovered going through the due diligence process. So how long is the due diligence period on a typical commercial real estate project? The due diligence period is negotiable and is determined under the contract negotiation. So there is no hard and fast rule of how long the due diligence period could go. If a seller is willing to give you 1 year to do due diligence, then you've got 1 year. Most of them don't. Most buyers usually request 30 to 45 days for the due diligence period and an additional 45 days to close. So full life cycle, is around 90 days. Sometimes there's due diligence fees that have to be paid. So the due diligence fee is an amount paid by the buyer directly to the seller that is theirs to keep, period. If the deal closes, the buyer then will credit that amount towards your purchase price. If it doesn't, they get to keep your due diligence fee. Also, sellers typically are going to require earnest money that is generally refundable for a period of time, and then after a period of time, it becomes non-refundable. So earnest money is a deposit made to the seller showing the buyer's good faith in the transaction. This allows the buyer additional time when seeking financing. Sometimes if you run out of time on your 90 days and you need an extra 30 days, some sellers will, and generally it's negotiated in advance, will allow an additional earnest money deposit that's non-refundable and give you an extension of time. That is generally negotiated in advance. Is typically held in a trust or an escrow account, so you don't just send it to the seller. You're going to use a title company to hold those funds to make sure that in the event the transaction doesn't close and you're still in your refundable period, that those monies can come back to you without dealing with the individual. And typically, earnest money is refundable up to a certain date, then it goes hard. So when your earnest money goes hard, that means if you back out or the deal doesn't close for any reason, the seller can keep your earnest money deposit and then go sell the property to another person. We've had that happen on properties we've sold, and it is not a good experience for the potential buyer if they're not able to close. So let's talk a little bit about owners and management of investments. So the investment opportunity process. The sponsor determines the objective for the property and creates the investment opportunity structure around the investment objective. So you might structure the investment for investors based on what the objective is as a hard money loan. You may not want to share in the equity, or maybe you don't. You're not intending to hold this property long term, and you don't want to split the profits, and you want to offer investors a fixed interest rate. You could structure it as a hard money loan. You can offer an investor a preferred return plus equity in the deal, or you could do a straight equity split. This is just a couple of examples. There are literally a myriad of ways you can structure your investment. There's a wide variety of different waterfall thresholds and things like that. Generally what we found is a confused mind says no, and if it's too complicated to understand, most investors are just not going to move forward. So my suggestion is, if you are syndicating deals, that you keep your investment structures as simple as humanly possible. And the examples I just give you here are the three simplest things for investors to understand. I'm going to get an interest rate, I'm going to get a preferred return, plus I get part of the profit, or I'm just doing a profit split with the sponsor. Those are the three easiest structures. We try to structure all of our investments, if possible, with one of these three options. Marketing materials and private placement memorandum has got to be organized before investors can actually do an investment. The sponsor organizes a special purpose LLC to take possession of the property. Investors participate through a private placement memorandum and own units of interest in the LLC that takes direct ownership in the property. The workshop, one of the workshops we did, how to invest, entity structures for investing. We talk a little bit more about that. So if you haven't watched that one, I would suggest you do that. We go into a little bit more detail. The sponsor is the managing member and oversees all aspects of the transaction from purchase to the ultimate sale. And passive investors' only responsibility is to invest, and in addition to that, be familiar with the investment reports that come out on a regular basis. There is a difference between asset management and property management. And so let's cover that. The sponsor is the asset manager. The asset manager manages the property management company. A lot of multifamily owners that are absentee owners and rely 100% on the property management company to ensure their investment does well, sometimes gets upside down, and a lot of them lose their properties because they're not paying attention to the quality of the management of their investment. So again, nobody cares about your money more than you do. Property managers get a percentage of the gross revenue that's being collected. And if the property is doing bad, they're still getting paid. They're just getting paid less. So you need to be actively involved. So if you are an individual multifamily owner and you have a third-party property manager, you need to be the asset manager and make sure that you're staying on top of, meeting regularly, reviewing financials with the property management company. The asset management is a hands-on approach versus an absentee ownership. You want to make sure that you are involved. So if you're the sponsor, you are the active investor. And if you are the capital investor that has written checks, you're the passive investor, and the active investor's responsibility is to act as the asset manager. Property management is at the property level. If multiple properties are involved, there will be, and you're using the same property management company, you're going to probably wind up now working with a regional property manager. So a regional property manager manages the property managers at each property. The asset manager would work directly with the regional manager primarily. That doesn't mean you're not going to show up to the properties yourself. You need to also make sure you're staying on top of the individual properties as well. And then you can either outsource your management or you can have management in-house. And sometimes it makes sense to bring management in-house and sometimes it does not. Property management isn't a huge moneymaker if you do bring it in-house, but you do have a little bit more control with in-house management, and you can offer additional incentives to ensure that everybody is incentivized for success. So most real estate companies initially outsource property management. The structure works well provided there's a hands-on approach from the asset manager. Outsource management typically has no ownership or equity incentive. So if I'm going to go hire XYZ property management company and I've checked them out and they manage the kinds of properties that we have and the number of units that we have and the neighborhoods that we're in, and they're a good fit, they're simply getting a property management fee. They don't care. In fact, they're afraid when you sell because the property sells. It usually means that the property management company is going to get changed out, and the employees that are there are concerned that they're going to lose their job. So once the sponsor has a large enough portfolio, they may at that time bring property management in-house, but not necessarily. And so if you do, in-house property management can be incentivized with ownership and equity. This works very well if you have a really good property manager that's maybe managing properties on a smaller scale and wants to work directly with one company that has a large enough portfolio so that their property management fees stay basically the same or similar to what they were before, plus they get upside. They're highly incentivized to make sure that the properties are being managed effectively. The sponsor would still act as the asset manager in this scenario for maximum results, but you're the asset manager working with your in-house property management company. So to wrap up, we're going to do a little test and some Q&A just to go through what we just covered and make sure that you remember everything. So what is the difference between an active and passive investing? Active investing, the active investor is doing all the work, identifying the property, and the passive investor is simply writing a check and participating financially. What is the active investor's job? The active investor's job is to find good investment opportunities, oversee those investment opportunities, report to the investors. And the active investors, what is the active investor's responsibility to the passive investors? To make sure that the passive investors stay informed. Through the whole process, good, bad, ugly, or indifferent, investors need to know what's going on and report to them. What is the passive investor's job? Passive investor's job is to do their own homework, conduct their own due diligence, be familiar with the investment, and make sure it's in line with their investment objectives. And the passive investor's responsibility, their only responsibility, is to write a check, and then also would suggest that as the reports come out, read them so you're educated on what you're investing in. And what's the difference between transactional investing and cash flow investing? Transactional investing is generally something that's going to be done short term, like fixing and flipping a home. If you're an active investor fixing and flipping homes, you own a job. You're constantly having to continue to fix and flip homes. Cash flow investing would be something like a multifamily property or a single-family rental where you're using third-party professional management and you're receiving mailbox money. That's cash flow investing. What's the difference between active income and passive income? Active income is taxed at your ordinary income tax rate. Certain investments that produce short-term capital gains and other kinds of income that we didn't cover here could be considered active, and they're taxed at the highest rate. Passive income is generally taxed at a flat rate, and in most cases, especially with real estate, you also have flow-through depreciation deductions and some year one cost segregation and bonus depreciation deductions that can help offset that. You want as much passive income as possible and as little active income as possible. How are refinance proceeds taxed? If you refinance a property, remember, loan proceeds are not taxable at the time they are received. So if you refinance a property and you get a huge loan proceeds distribution check, you're not going to owe any tax on it up until the point that the property is sold. What is due diligence? Due diligence is just simply doing your homework before you make an investment. A lot of investors that I've worked with do what I call haphazardly investing. They hear an investment, a stock tip, and it sounds good, and then they just go invest, and they have absolutely no basis for making the investment decision. Just because you do your due diligence doesn't mean that eliminates risk, but it certainly does reduce the risk, whether you're on the active or the passive side. Why is due diligence important? Because if you don't conduct your due diligence, you could be overpaying for a property. There may be a lot of things going on that you're not aware of. All kinds of things come out in the due diligence process that affect the price that you're going to pay, or if you're even going to do the investment. For every one multifamily property our investors see, we've gone after 50 to 100 properties, put offers on 10, underwrote 5 to settle on 1 that actually makes financial sense. So the best investment that we've done is sometimes the investments that we don't do. I'd rather not do a bad investment than do one, and it's better to just make sure that you are only investing in things that pass through your due diligence process. And what does it mean when earnest money goes hard? That means that you can't get it back. It's non-refundable at that point. So going hard means non-refundable. What's the difference between asset management and property management? Property management manages at the property level, and the asset manager manages the property management company, whether it's in-house or outsourced. And to have a successful real estate investment, the asset manager has to take a blank approach. An asset manager needs to take a hands-on approach. You can't just rely on your property manager to make your investment work out. There's some great property management companies out there, but if you work together as a team, they also understand what you're looking for, and you can help them achieve your objectives on what you are expecting for the property, and they can also help you keep your expectations in line based on what's going on at the property. And when does it make sense to bring property management in-house? It's really once you have a large portfolio. That's about the only time it makes sense to bring it in-house. That doesn't mean you should, but that's when you would. And with that, I want to thank you all for joining me. I hope the information we covered was educational and informative. And again, if you want to connect with us, you can just text the word passive to 66866. You can also reach us at investwithdmi.com on our website, or you can call at the phone number below. And you can also email to invest@dmi-mgt.com. Thank you for joining me today.